There are basic and fundamental knowledge that every investor should have. It is not enough to put your money, to have the money to put in any investments or any assets. You should have the basic information, you should have the basic knowledge, the fundamentals, the essential concepts that will help you to perform well in the market and to maximize your return on investments. Knowing your why is powerful. Knowing your how is also powerful. Then when you know your why and your how, then your what becomes easy. You will know exactly what to invest in. So at the end of this training, at the end of this course, you will know what exactly you are looking for whenever you want to invest. You will know what exactly. So on this note, I welcome you to this course, Investment for Beginners, essential for every beginner investor. It is not only meant for those who are just starting out, even those who have already been investing, because many people have been doing it the wrong way. At times I come online, I teach online, and I see questions people are asking. I wonder, how come you have put your money into such an investment and you never know that this investment is not what you should put your money into? Because we have different objectives, different reasons for investment, and that's one of the things that this course is going to expose you into. So quickly, let's look at the agenda for this investment course. What is it that you are going to be learning? And this is good for any beginner, as long as you are not yet a professional in investments, and no knowledge is even a waste, even if you are a professional. So let's jump into it. The primary goal behind, I need to remind you this, the primary goal behind all investments remains the same: to increase the value of your money. That is the major reason. Every other reason is now secondary, but the primary reason behind every investment remains the same, which is to increase the value of your money. So what is the agenda? Number one is for you to understand the 3 M's of money. The 3 M's of money. When you understand the 3 M's of money, then it helps you, it gives you a foundation in the investment world. Then we look at, why are you investing? People invest for different reasons, but one thing I've come to realize is that more people just want to invest, forgetting that there should be an objective for why they are investing. Why are you investing? So we are going to be looking at that, and I will say that this may be the most important part of this training, of this course. Then we look at determining your investment timeline. You need to determine your investment timeline. How long are you investing for? When you know why you are investing, you will be able to determine your investment timeline. Then we look at assessment of your risk appetite. If anybody is telling you, recommending any investment to you, the question is, do you know the person's risk appetite? Do you know your own risk appetite? Your own risk appetite may be different from that person's risk appetite. By the time we get to assessment of risk appetite, you will understand better. So don't be in a rush, just be patient. Then we look at choosing the right investment. Once you are able to determine your why, you are able to determine your investment timeline, you are able to assess your risk appetite, then choosing the right investments becomes very easy for you, very easy. I hope you understand. Then number 6, we look at how you can monitor and grow your investments. Without wasting much of our time, let's jump into it one after the other. Number 1 is understanding the 3 M's of money. Understanding the 3 M's of money. So what is the 3 M's of money? Number 1 is what we call making money. Making money. I want to believe you should know how to do this, even though there are many ways of making money. And even if you come online today, there are many ways of making money. And at the time of making this course, it's possible the course will not be ready, but you can check out our courses. There will be a course on how to make money, a plethora of ways of how to make money in this day and time, especially in this online space. So when we talk about making money, we are talking about active income. Active income means the income you make by you putting in your efforts, by you putting your time, and by you putting in your energy. It requires you putting any or the combination of these 3 that I mentioned. It requires you putting in your time, your efforts, or your energy. So that is what we call active income, which means it requires your active participation, your active engagement. That is what we call making money. So for instance, your job, your 9 to 5 job, whether it is a contract job, it is a part-time job, or it is a full-time job, what you are generating from such is what we call active income. So for instance, if you are not going to your place of work, you didn't go maybe for months, which means there will be no salary. If you don't go, there will be a query. If you don't go, there will be consequences, which means you cannot do without going to that place if you want to earn that income. Number 2 is your business. As long as your business cannot run without you, such as the level of Dangote. Dangote has gotten to a stage where its business can run without him. Jim Ovia has gotten to a stage where Zenith Bank will run without him. So if your business still requires your active engagement, you still have to be in your business frequently. I'm not talking about once in a while now. Frequently, it still needs your frequent engagement, frequent participation. What you are having is called active income. Then we have skills and services. What skill do you have? Maybe you are a freelancer, you are a graphic designer, you are a carpenter, you are a furniture. All this, what you generate from there is what we call active income. Without you engaging in those services, servicing your clients, those income will not come in, will not be earned. Now we have career. The money you also generate from you having a career. Maybe you are a medical doctor, you are a chartered accountant, you are an architect. Whatever income you generate from there is also called active income. If you don't service your clients, if you are not engaging with your customers, it means no income is coming in for you. And we have several ways like that you can generate money in this day and time. Active income. So making money requires your time, efforts, and energy. That is number 1 aim of money. Number 2, but a major limitation of making money, of this active income, is that without you putting in your time, effort, and energy, you can never generate them. So which means if you only have to rely on active income, you will have to work till you die. You will have to work till you die, which means you can't even say you want to retire one day. That's why you see people working for 35 years and afterwards they are now waiting for pension, and when government is not paying their pension, they are stranded in life. And that's why you need to think of what we call passive income, which we are going to talk about the third end. You need to think of passive income, and I don't want to rush, I want to take it step by step. So that is the major limitation of active income. You will always have to put in your time, effort, and energy. And whether you like it or not, a time will come where you will no longer be able to engage in that activity as you used to, whether due to old age or due to health issues or due to health issues. So you need to plan. So making money is good, but please don't be limited to making money through active income. What is the second M? Managing money. You need to know how to manage money after you have made money through active income. You need to know how to manage it, because if you don't know how to manage it, you will at the end be like someone like Mike Tyson, who made over $300 million in his boxing career through active income. But at the end, he had to file for bankruptcy due to him not knowing how to manage money. And we have heard of several stories of people like that. When they were making money, they were making stupendous money, but they don't know how to manage money. Managing money is a skill. You need to manage money, because it is when you know how to manage money, that's when you will be able to now move to the third end. So how do you manage money? We are talking about knowing how to budget your money. And when we talk about budgeting money, it is not just limited to accountants or economists. It is for you and I. And we are not just talking about picking a pen and a paper and you just begin to write down figures. You can just use simple formula for managing money. By the time you check our course on the 3 M's of money, it will be broken down. How to manage your money like the 1%. How to manage your money like the 1%. Several methods of budgeting money that is simple even to a common man is stated there. The BSP formula, the FFF formula, the 50-30-20 formula. You just have to pick the one that suits you, and eventually you will be fine, because you need to know how to manage money. Budgeting your money, protecting your money. You need to know how to protect your money from vampires, from termites. We have different kind of people who want to eat from that your hard-earned income. Those with entitlement mentality, those with dependency mentality, depending that you owe them something in life, and they will appeal to you emotionally. Some will even bully you emotionally just to get at you, just to get your money. So you need to master how to protect your money from these kinds of people, and you are being surrounded by such, especially by those called family and friends. And number 3, you need to know how to save money. We save money for many reasons. We save money for consumption, we save money for emergencies, then we save money for the last part of the end, which is multiplying your money. You need to know how to multiply your money. Multiplying your money simply means knowing how to grow your money. Investing. This is the kind of income you generate passively. It doesn't require your active engagement. This is the stage where your money works for you. So you save for consumption, you save for emergencies, then you save for investments. So that's why I said managing money is a very important skill you need to acquire. You should check our under the free course or the premium course. You should see a course there which will teach you how to manage your money like the 1%. Investing your money. This is when your money now begins to work for you. So the goal is to get to a stage whereby the passive income you are generating exceeds your active income. Can you imagine, as a salary earner, maybe you are earning 50,000 naira per month, and you've now gotten to a stage where your investment is now giving you, let's say, 400,000 naira per month. Do you know that at that point in time you can decide to retire, you can decide to resign? Not necessarily you getting to the age of 60 something, you getting to the age of 60 before you resign, before you retire. If you have a business, for instance, you will not be compelled to take up a particular price just because you need to sell. Some business owner will have to take a particular price, or maybe reduce their price just to make ends meet, just because they need to make sales. They need to do the bidding of their customers just because they need that sales in order to have their ends met. I hope you are getting value. So it is imperative you know how to invest money. Investing money in different assets, knowing the concept of diversification, and there are many courses on investment on this platform already. So you can check the free courses and you will check under the premium course as well. Don't forget, knowledge could at times be costly, but you need to seek it. Buy the truth. That's what the Bible says. Buy the truth and sell it not. So at times you may have to buy it, because knowledge is the best investment you can make. When you have invested in knowledge, then investing becomes easy. Just like you are watching this course now, you are investing in knowledge. I hope you understand. Let's move on to the second module, which is, why are you investing? Determine your investment objective. You need to get clear with your why. When your why is clear, then your how and your what becomes easy. And that's why I said this is the most important part of this training, of this course, and you need to pay attention, because our whys are different. The reason why we are in the investing market is different. The reason why one is buying this, another one is buying the other, is different. But what we have today is somebody just recommends to you, buy this, invest in this, and you are not asking why. Does it fit your investment objective? Because we have different investment objectives, and this needs to be settled in your mind before you put your money in any investment. That is what makes you to be stable in the market, when your objective is clearly defined. So let's move into it. Now, we have two perspectives. This is perspective one, and we are talking about four people here. We have Mr. Emeka, Mr. James, Mr. Larry, and Mr. Ahmed. Now, Mr. Emeka, for instance, his own investment objective is for retirement. He's a civil servant, and his goal is to work for 35 years, and at the end he retires. He wants to use it to complement his pension. So he knows that there's pension by his side, and by the time he retires, he doesn't want to rely on pension alone, seeing what pensioners go through after they have retired, having to be on the queue waiting for their pension, the government not paying their pension on time. He doesn't want to go through that stress. Peradventure, they don't pay their pension on time, their pension is being delayed. He has another asset generating money for him at that point in time. So that is his own objective for investing. Now, Mr. Emeka is definitely different from Mr. James. Mr. James wants to retire early. He is not planning to wait till after 35 years before he retires. Maybe he just wants to work for 20 years or 15 years, and after which he retires to do something else, to do what he really wants to do. I don't know whether you know this code that says do what you have to do so that you can do what you really want to do. Maybe he has a passion for something, but he knows that for him to get to that point, he needs an asset, he needs to have an investment that will be taking care of his need. So if that passion of his is not giving him money, is not part of, because its investments will be giving him money. So you see one who has an investment objective of 35 years, while another one has an investment objective of, say, let me retire early, and by 15 to 20 years I've retired so that I can face what I really want to do in my life. I want to go and face this. So even if for the first few years of what I'm doing is not producing money, I have an investment that will take care of my needs. So you can see that these two will definitely invest in different vehicles, in different assets, or in different instruments. Then we have Mr. Larry, who wants to invest for his children. He is to invest for his children. So he needs to look for maybe an investment that has compounding effect. So when somebody comes online and says, oh, invest in treasury bills, invest in FGN savings bond, all this we are going to get there, choosing the right investments. Invest in treasury bills. He knows that what I need is a compounding interest investment, so that this can work in favor of my children, so that I can maximize the return on investment for my children. So you can see that is another vehicle entirely, is another strategy entirely. So it is not a one size fits all investment. You need to be clear with your why. It will help you to know the kind of investment you should venture into. Then we have the last person in this perspective, which is Mr. Ahmed. Mr. Ahmed wants to invest for regular cash flow. So which means Mr. Ahmed, for instance, will not go into something like land banking, because land banking will not give him regular cash flow. He needs something that will give him consistent cash flow. So maybe, for instance, he may decide to do FGN bonds that pays twice in a year, or FGN savings bonds that pays 4 times in a year, quarterly. Or maybe invest in a dividend paying stock that pays 4 times in a year. You can see that different strategy. For Mr. Larry, it could be a compounding interest investment. For somebody who wants regular cash flow, it is to look for an asset that pays cash, that pays dividend, or that pays interest on a regular basis. So that's one perspective, looking at these 4 people. Now let's move to another perspective. We look at another 4 set of people. This is another perspective. Mr. Tunde, Mr. Chima, Mr. Jibril, and Mr. Cosmos. Mr. Tunde wants to invest for wealth creation. He wants to create wealth, which means he wants to create it. He may look at going in and out of the market. The moment I make 20%, I'm okay. The moment I make 30%, I'm okay. He wants to create wealth with it. It's different from Mr. Chima that wants to build wealth. Mr. Chima has a vehicle that creates wealth for him. He only wants to build it up. Creation and building is different. They are two different concepts. Creation means this is more or less like a source of livelihood. I want to create wealth with it. I've seen potential in this market with this investment, and I want to create wealth with it. So definitely the strategy we'll be deploying will be different from somebody who wants to build wealth with it. Somebody who wants to build wealth may be passive with the investment, while the person that wants to creating, it's more or less like an active thing. It needs your active engagements. Then we have Mr. Jubril, who wants to preserve wealth. He doesn't want the value of his money to go down. He has made money in another sector with his active income. You remember, active income, passive income. He just wants to preserve his wealth. He doesn't want inflation to erode the value of his wealth. So he may be looking at, okay, maybe I should invest in real estate. Maybe I should invest in digital assets. Maybe I should invest in foreign currency in order to hedge against inflation. Hedging against inflation is a major concern for Mr. Jubril. You can see different objectives. We have Mr. Cosmos, who wants to retain wealth. He wants to retain wealth, maybe for generation unborn, for his third generation. And one of the ways they do this, for instance, wealth retention, is through stocks and shares, is through real estate. I hope you are getting my point. So these are different perspectives. So you are the one that will get your why. Why am I investing? I hope you are taking notes. Let's move on to another perspective. This is another perspective. We have this lady who wants to invest just to fund a lifestyle. She wants to be going to Dubai every year. That's the lifestyle she wants. She just wants to go on vacation to Dubai, or maybe to the UK. So he's looking for an investment that will be sponsoring that lifestyle. I hope you understand. This is another objective. We have another person who wants to finance a project. There's a project he has in mind. He's looking for an investment that will finance that project. Maybe he wants to build his second house. He wants to build his vacation home. That's another perspective. Then we have another person who wants to invest for legacy purpose. He wants to use it to create a legacy for his generation unborn. You can see that I've mentioned 11 different investment objectives. Know your why. It's going to help you a lot in determining the kind of investment you should go into. Let's move on to module 3, where you need to define your investment timeline. You need to understand that there are timelines. When we say timeline, it means time horizon. How long do you want to be in the market? This also will help you to determine which kind of investment you should go for. Number 1, we have the short-term investment, which is between 90 days and 3 years. Between 90 days and 3 years. Short-term. So for instance, you want to invest for 6 months. Definitely you can't go for land banking. Definitely you can't even go for land flipping. Definitely you can't even go for growth stock. Definitely you can't even go for dividend stocks, which means you have to go for treasury bills. You have to go for commercial paper. So when you define your investment timeline, this will also help you to know the kind of investment you should go into. So determine your investment timeline. When you want to invest for 2 or 3 years, you may say, what kind of investment can I go into? That may be FGN savings bond, because that is an investment that is within that time frame. That is short-term investments. Then we have mid-term investments. This is for 3 to 10 years. You want to invest for between 3 to 10 years. Definitely that could be investing in FGN savings bond, corporate bonds. Defining your investment timeline. How long do you want to invest this money? So you can see that it is not enough for somebody just to come online, or you take a random recommendation online. When it comes to investments, you hear that they are investing somewhere, the next thing you go and put your money. You hear that they are buying stocks, you want to put your money. You don't know whether it is dividend paying stocks or it is growth stock. It is your investment timeline, it is your investment objective that will help you to know the kind of investment you should go into. I hope you are getting it. Now, number 3, long-term investment. Anything above 10 years is long-term investments, depending on the industry. But we just categorize it. For instance, if it is real estate, it is anything above 15 years. Because one thing about real estate investments is the maturity of that investment. It usually takes a while before it begins to mature, except maybe you're investing in a place like Lagos. That's Nigeria when it comes to investing in Nigeria. So long term, if you're investing in the financial markets, anything above 10 years is long term. So you may be looking at shares and stocks, growth stocks. You may be looking at land banking above 10 years. I hope you get my point. So define your investment timeline. How long do you want to invest this money? Don't go and use short-term investment timeline for long-term investment timeline. You want to invest for your children now. You are now investing maybe for treasury bills, that 90 days treasury bills, except you just want to do it for short term. Maybe you want to buy something for them during Christmas, during the festive period. You say, okay, this is September, let me just invest this money so I don't leave the money I do in the bank. Except for that, you should go for an investment that has maybe compounding effects, that pays dividend, that has both the cash flow side and the capital appreciation side. Those are the kind of investments you should go for when it is long-term investments, and maybe you want to invest for your children. Then let's move to the next one. Then this module we want to talk about assessment of your risk appetite. You need to understand that it is not every investment that suits your kind of investor. Maybe you are an active investor or passive investor. Not every kind of investment fits you, because you need to understand that there's something called risk appetite or risk tolerance. You need to assess your risk appetite before you venture into any investment. So I've spoken about knowing your why. I've spoken about investment timeline. Then let's look at assessment of your risk appetite. Primarily, we have 3 types of risk takers. Number 1 is the risk averse type of person. We have the risk neutral, then we have the risk seeking. I'm going to explain this one after the other, so you know the kind of person you are, you know the kind of investor you are. So let's start with the first one, which is the risk averse investor. We also call this type of investor, this kind of investor, conservative investors. Conservative investors take the least risk in the market. They do not indulge in risky investments at all and go for the options they feel are safest. A major concern for a risk-averse investor or a conservative investor is the security of their capital. So if you are the type that once you want to invest in anything, you are so concerned about the safety of your capital. You are so concerned, the security. I hope at the end I'm going to get my 1 million naira back. I hope nothing will happen to my 1 million. It means you are risk averse. That's why someone like you can never gamble, because you are so concerned about your hard-earned money. Even if nothing is going to be added onto it, let the one I have, don't let it lose value. I don't want to lose it, the one I have made. A major consideration for a risk-averse or a conservative investor is security of their capital. I mean capital, the money you are putting into the investment. So anything that is risky, Yoruba people will call it anything to batile jogedelo, which means anything that is beyond the normal. I don't want it. So if you are that kind of investor, which means when they are talking about cryptocurrency, for instance, you know it is a no-go area for you. When it comes to their trading shares and stocks, it is no-go area for you. You can still manage dividend stocks. Investors like that loves government securities because they are risk-free assets. So they go for treasury bills, FGN savings bond, FGN bonds, fixed deposits. So are you that kind of investor? Know yourself. So you know that when they are talking about some investments, it is not for you. Number 2 is the risk neutral investor. These are moderate risk investors. We call them moderate risk investors. Moderate risk investors are relatively less risk tolerant when compared to Aggressive risk investors, they take some risk and usually set a percentage of losses they can handle. In the case of a risk averse person, that one, nothing must happen to it or to his 1 million naira or 1 million naira. For a risk neutral person, the person can still take, okay, if I invest 1 million naira, at the end if you say I'm going to collect 800,000 or 900,000 naira, I don't mind. Or maybe they are investing in shares and stocks and there is a downward trend, it can still go down to like 800 or 900,000 naira. They are still okay with it. But a risk averse person, nothing must happen to that 1 million naira. I hope you get the difference now. So if you are the person that can still take a level of risk, but you are not like a risk seeker. A risk seeker can go in as 50% drawdown. When we say drawdown, that 1 million naira can still come to as low as 500,000 naira. They know that life is more or less like it's a risk on its own. So they see life as a risk, so they are willing to take risk, but not to the extent of gambling. They are not gambling. We are talking about calculated risk. It can go their way when they have calculated risk. Gambling is another thing entirely. It's not investing. That one, there's nothing like calculation when you are gambling. When you are throwing dice, you are playing what? Those ones are casino. Those ones are not calculated. But when we are talking about investments. We are talking about calculated risk. That you are saying that looking at the financials of this investment, of this company, I can see that they have a good prospect, they have a solid business concept. I expect them to do well in the market. Peradventure, they do not do well. Peradventure, you can still take a drawdown because they have a solid fundamental. You know that on the long run they are going to perform well. So when there is a drawdown, you can still take that losses, and eventually maybe it will now pick up later. I hope you get my point. So that is risk seeking investors. They are aggressive risk taker. Those are the kind of investors that go into cryptocurrency. A risk neutral person don't go into an investment like cryptocurrency. They prefer going for moderate investments with little risk. Aggressive risk investors are well versed with the markets, you can see, and take huge risk. Such types of investors are used to seeing large upward and downward movements in their portfolio. Aggressive investors are known to be wealthy, experienced, and usually have a broad portfolio. So if you are starting out, it's better you start with the minimum. Start with fixed income investments. There's a course on fixed income investments. It's under the free course. You can take it. Then eventually, if you want to know more about the fixed income investment that you can do, there are courses on it in the premium course. FGN savings bond, FGN bonds, talking about treasury bills. We have courses on it in the premium course. So that is knowing the kind of risk taker you are. Let's move on to the next module, which is choosing the right investment. When we talk about choosing the right investments, you need to know that we have fixed income investments, then we have flexible income investment. If you are a total newbie, it is better you start with fixed income investments. Fixed income investment simply means the income you are expecting, the interest you are expecting is fixed, and it also comes to you at a fixed schedule. You can take a course on fixed income investment. It is free. It is in the free course session. So let's look at some of the fixed income investments. We are talking about bonds. We have different types of bond. We have FGN bonds. We have FGN savings bond. They are different. We have subnational bond. We have government agency bonds. We have corporate bonds. We have different types of bonds. It is explained in the fixed income investments. We have fixed term deposits. So you need to choose. As a beginner, go for fixed income investments. Fixed term deposits is a flexible type of investment. For detailed explanation on this kind of investment, knowing how to choose which in fixed income investment to choose, watch the video, watch the course on fixed income investments. No knowledge, it is good to seek knowledge before you invest your hard-earned money. Then we have treasury bills. Treasury bills is from 90 days to 364 days, is within a year. And the last but not the least, under fixed income investments, we have more than this is explained in detail in fixed income investment. We have commercial paper. Commercial paper is issued, it's between 30 to 270 days. It's also a short-term investment. Majority of these fixed income investments, they are short-term investment, except for FGM bonds and corporate bonds. Those ones are usually long-term. And fixed-term deposits is flexible. You just want to fix it there, and it is flexible. You can decide anytime. Maybe it is for 30 days, it's for 60 days. You are the one that will determine the timeline. Then let's come to flexible income investments. This is unpredictable. The income you are expecting is unpredictable. It fluctuates. It depends on the performance of the economy. It depends on the performance of the markets. So mutual funds is one. Commodities, for instance, gold. You don't know how the gold markets will be. Gold, silver, artifacts. Those ones are not common here, but gold and silver is something you can venture into. Commodities, you don't know how soon they will appreciate. You don't know with what percentage they will appreciate. Their value is going to appreciate. So the income is flexible and is unpredictable, unlike fixed income investments. Then we have shares and stocks. Shares and stocks is a very good way to hedge against inflation. You want to make money, shares and stocks is a very good way to make money. But please, first of all, watch the free course on it. And if you want to dive in further, you can take the shares and stocks investment 2.0, cost 2.0. But first of all, take the free course on it. It's a very good way to make money. People create wealth with it. People preserve wealth with shares and stocks. And the last but not the least is real estate. Real estate also is a very good investment, and the income from it is unpredictable because you are not the one that will determine the forces of the market, what is happening in the market. Even if you decide to sell your land, maybe you invested in a particular land, you are not the one. It is the buyer that will tell you that this is what they are selling land in this location. Maybe they are selling land at, let's say, 10 million naira per plot. So you cannot say you want to sell your own 15 million naira. And how soon the land appreciates, you are not the one that will determine that. It depends on the so many factors: development, demand and supply, government decisions. Those are the factors that determine how your real estate will appreciate. When we talk about rental properties, we have vacancy rates. You are not the one that will determine how people will demand for your property, even though it may be in an eyebrow area. But one thing is that there are so many factors that are unseen. For instance, there is maintenance. You have to spend money on maintenance. So at the end of the day, your profit or loss will have to be calculated. It is not fixed. It is unpredictable. That is what we mean by flexible income investments. I hope you understand. Then now let's move to the last module, which is monitor and grow your investment portfolio. Monitor and grow your investment portfolio, which means it is not enough just to put your money in any investment, even though it is for passive income, but at least you need to be aware of what is happening in the market. So you need to monitor it. It could be quarterly, it could be yearly, it could be semi-annually. You just bust into your portfolio, see what is growing, see what is happening there. Maybe you need to adjust your strategy. So let's go into it. So you need to know how to monitor and grow your investment portfolio. So you don't just leave it there. It is not a one-time thing. It is you are called an investor, which means it's something you do on a regular basis. So number one is to review your portfolio regularly. So pick a time. It could be monthly, just like you review your finance. It could be monthly, it could be quarterly, depending on your strategy, depending on your goals and objective. Review your portfolio regularly. Don't leave it to chance. You don't know what is happening in the market, and eventually maybe you have bought into a stock and the stock is plunging, and maybe it's a serious fundamental that is making it to plunge, and maybe you need to get out of the market. You never can tell. So review your portfolio regularly. Another one is adjust your strategy for major life events. Things change, circumstances change. So maybe for instance, your plan is to retire at maybe age 65, and now you are now considering retiring on time. You may want to consider your strategy, that I need to adjust my strategy. I hope you understand. So there are major life events that happens that may want to make you to adjust your strategy for major life events. The last but not the least is add to your investments regularly. Add to it. Please don't just make it a one-time thing. You have invested 1 million naira. No, just add to it so that it can grow over time. It is meant to grow your money. When I spoke about it at the beginning, I said multiplying your money simply means growing your money. So when you add to it regularly, it grows over time. Then join an investment community. This will help you when you are in a community of like-minded investors. With this, we have come to the end of this course. So if you have any inquiries or consultation, this is my WhatsApp number, official WhatsApp number. So you can message me, and you can go through our page on the free courses and premium courses. See the ones that will benefit you and take them. Seek knowledge. It will help you to grow your finance. Thank you for staying tuned to the end. And also you can subscribe to YouTube channel of this very instructor, which is Korede Alayaki. My YouTube channel is Korede Alayaki. You will get more update there. You will get more knowledge there as well. Thank you. God bless you.